Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, everyone. Today we've got our usual trio of topics for your delectation, although one of them might leave a slightly bitter taste because it's all about the soaring price of cocoa and therefore chocolate. Madelaine Apthorpe is here to talk about what's causing the price rise, what companies are doing in response, and what it means for our confectionery consumption. We are also taking another look at plane maker Boeing, which has the new problem of a machinist strike to add to existing issues over safety and supply chain constraints. Julian, Hoffman and Mark Robinson will discuss what's next and examine the fallout for a range of UK-listed companies as well. Before all that, though, our cover story this week is on the weighty topics of debt, demographics and money, how Western economies can deal with competing pressures, and what kind of companies can rise above it all. The author is James Norrington. James, as we record, we just had it confirmed that you, like us all, have once again been passed over for the Nobel Prize in Literature. I make that same joke every year, but I enjoy it. But nonetheless, hopefully you're not too dissuaded by that snub. Tell us about this piece, because it's quite a weighty topic, quite a complex topic. What's the thinking behind it? What are these competing forces?
Well, I wasn't aware of the Nobel Prize of Literature. That's how far off the radar I think I was.
Maybe next time.
So basically we have, at quite a juncture for humanity and markets and Western economies, we have big secular risks and short-term cyclical risks around deflation and inflation, and which two opposites, but yet we have to plan for both as investors at the moment. The big picture risk is deflation, which is the thing that we're worried about because of shrinking populations, fewer workers, a depleted capital stock as the baby boomers retire. And obviously deflation is where prices fall, which people would think, well, that's funny, and we've just gone through inflationary risk, but it's a vicious cycle. People delay purchases, company profits fall, investment plans get shelved, businesses fail, and the economy shrinks. That's the thing that they're all worried about. That's why governments are trying their best to intervene and try and stimulate growth. But then, in the short term, there are sort of cyclical inflationary risks when they get that wrong and they spend too much money in too short a space of time. We all know inflation is caused by too much money chasing too few goods. There are other sort of shorter term within the broader overall deflationary risk of shrinking populations and fewer workers. In the short term, that can be inflationary because you've got higher labour costs. And then also chuck into the mix, you've got an energy transition, which in the long term, hopefully will be cheaper, cleaner energy. But in the short term, there will be price spikes due to supply bottlenecks.
Yeah, it's quite hard to sift through these competing issues, isn't it? And try and balance, certainly if you're a government, try and balance spending, taxation, everything else to try and produce growth at the same time as avoiding both these downsides.
Well, governments have a problem because there is a need for government investment, but the governments also have their regular spend, which is ballooning. As older populations mean more spending on healthcare, more spending on pensions, and no politician likes doing the unpopular things when it comes to making these choices. And yet, financial markets who lend money to the governments, they get a bit jittery about this. The UK's borrowing costs have risen the last week in anticipation of Rachel Reeves' budget, just on the nerves. And as she'll be acutely aware of what happened with Liz Truss 2 years ago. For retail investors, our audience, you're thinking about how can you invest and what companies, what characteristics of good stocks that you can invest in to help you sort of to plan for sort of to hedge your bets on either situation. You're looking for companies that really quality companies that can grow profits ahead of GDP, can generate consistently high returns on their own investment, and that they're cash generative so that they don't have to rely too much on financial leverage. And also stock picking and cycles are just going to be more important because of these policy regimes and the less predictable economic backdrop.
Yeah. Well, in the piece, you look at companies producing good levels of cash, companies with high returns on capital, and we've got some examples, some tables of those. But it's important to state that those metrics, as with any metric, shouldn't be viewed in isolation. There are other things to consider.
Well, stock screens and relying purely on screens, sort of smart beta approach. I think one of the things is actually beta and passive investing is going to be harder with all these things, and smart beta, an in vogue trend about sort of a decade ago. That's a bit daft as well. I mean, it's active stock picking. Screens are only ever a starting point, but one of the best sort of entry points for actually looking at companies that are good at investing is to
Mm.
look at their return on capital employed and their return on capital invested. So return on capital employed is really just looking at how well a company's run. It's the operating profit, looking at the return on average total capital. Return on capital invested, that's looking at the net income. And it's looking at the average total capital invested, which is just long term debt, doesn't include the short term. And that's really that gives you an idea of how well a company is investing and making good on its investments. After tax, when all's said and done, and the ROCE is really looking at the ROCE is really looking at how well it's run year to year. It's useful to look at both of those metrics. They are flawed, however. I mean, I think you need to add. I think one of the things that I look at as well. I mean, I pull up a few companies, and not all I'd say would be buys in those tables. I mean, I think it's important to state that, because you want companies that also have good cash conversion, because you want, there's going to be issues sometimes with revenue recognition, and accounting profit isn't quite the same as cash profit. Um, there's also liquidity concerns, very important. And another metric you can do, which sort of builds out on the return on capital invested, is to look at cash return on capital invested, which is really the cash from operations adjusted for changes in working capital, which again divided by the long-term invested total capital. And that gives you an idea of not only how well a company is investing, but how quickly it's actually getting cash in the bank, making good on that. And those companies are strong on metrics like that. I mean, some of them, again, it feeds into another risk, which is valuation risk, because everybody wants companies like that. It tends to be platform companies, digital companies, which are not very capital intensive.
Sure.
Which is why it's also important to look at something else, which is actually, you want to look at one is valuation. So you want to look at sort of a good way to look at it is the earnings yield and the spread of the earnings yield over or one over the earnings yield, the spread of that versus rates, just to give you an idea of valuation relative to the risk-free rate. But also you want to look at growth trends that are cyclical. You want to look at margin progression, and you want to look at forecast growth. So you want to see how well a company's done at growing its profits in its recent history and what it's forecast to do. And that actually may bring up a few more cyclical companies as well. And actually, I think that's going to be a part of the way that you build a good, robust portfolio going forward. You want a mix of those sort of quality compounders, which may have a bit of valuation risk at times. And there are going to be other companies that some of the energy majors, some of the miners that are a bit more cyclical, but are going to have phases where they do pretty well in some of this macro backdrop. So there are a lot of challenges, a lot of moving parts to think about.
Sure. Let's turn back now, though, because there's a lot of things to think about there, as you say, and there's a lot of things to think about with this piece in general. Let's turn to the government side of things, which is harder for a private investor to discern. Not that company selection is necessarily easy, but I want to talk about the two competing ideas of crowding in versus crowding out, which is when a government gets involved with making its own investments, as we've seen. Well, certainly there's a need for it. As you say, there's a need for infrastructure investment here and in the US. The US has had some big bills, some big acts in recent years, an industrial strategy, if you want to call it that, trying to encourage this kind of investment. But what are the tensions here in your mind?
Well, the traditional sort of any sort of anybody's ever read or watched anything by Milton Friedman
Mm.
back in the day, they will know about sort of crowding out theory. Higher real rates, basically government borrowing. It causes bond markets to sort of demand a sort of a higher, um, you know, real rates, because they expect more volatility and inflation. I mean, there's no real default risk with lending to the US or the UK government. Well, we hope not, anyway. But because they can borrow in their own currency, they can print more money. But then that causes inflation, which means that you want a higher real rate and a higher sort of risk premium for that possibility that the money you get back is going to be worth so much less than you lent. So that higher rate of real rate of interest, that creates a higher hurdle rate for everybody, for companies who borrow, and a higher hurdle rate for the cost of capital and the return on capital you invest. So it can discourage investment. And the other thing is also governments, when they're borrowing a lot, they tend to tax more, which means that, again, the burden of taxes again creates a hurdle rate, and all this has the effect of making it harder for companies to make good on investment. So it's sort of the fact that the government is borrowing and doing so much, it has the effect of crowding out the private sector. The sort of the free market theory is actually that private investors and entrepreneurs and companies, they invest better than the government does. They're more efficient, and so that's bad for growth overall. That appeals to me as a libertarian, but part of being a libertarian is actually not being dogmatic. And the fact is when you have declining populations and you have a declining capital stock because you've got so many people retiring and there's not enough people replacing that, and they've got a lower propensity to save, and therefore there's the Western capital stocks that were around in Friedman's time aren't there anymore. What won't be on at the same level. You need governments to kickstart some big projects which have big upfront capital hurdles, which are too high for private enterprise sometimes. And sometimes we've got the energy transition, which is controversial, but things like, if you wanted nuclear fusion, for example. So we talk about moonshot, and putting a man on the moon in the 60s was the equivalent that people talk about. A lot of economists talk about, say, you need to invest in moonshot projects because they won't happen otherwise, and the ultimate benefit of them is to increase growth. It's to increase the infrastructure for and make it cheaper for private capital to then go and have an environment to thrive.
Yeah.
So that's crowding in.
This is the crowding in, the Keynesian theory.
Yeah. So Keynesian as well is the government expenditure. It creates a multiplier effect in the economy, and company profits go up, and therefore they have more to invest. There's things to recommend them. The drawback with the Keynesian theory is if too much government money is created, and it creates inflation, and that sort of counteracts the effect as people spend less because the money isn't going as far.
It's fair to say, inflation is the constraint, which is the same across most economic theories. People would recognize that the controversy or the disagreement's always about the cause of inflation and what happens. Obviously, we've just been through a big inflationary episode, which we do discuss in the piece as well. But for a final point, let's look at the US. We could look at the UK, but I'm sure we'll be talking about the budget a lot more in weeks ahead. But in the US, clearly, we've got an election going on. What are the potential implications of the candidates' spending plans in future?
Well, it's quite hard to get clear plans,
yes.
As many US journalists are trying but failing. But there was a report out from Washington that the Financial Times covered that suggested that Trump's plans would add $7.5 trillion to the debt over the next sort of budget cycle up to about the middle of the next decade, and Harris's would be about $3.5 trillion. Now, the idea that anything is truly non-partisan in Washington is can be taken with a sort of a truckload of salt, I think. But I looked at a UBS report as well that was out today, which suggested smaller. They suggested that a blue sweep of the Democrats getting both houses and Harris presidency would add about 1.8 trillion, and a red sweep, which Trump and the Republicans would be about 4.3 trillion. That's largely down to Trump wants to extend his tax cuts, which would cost about 5 trillion. But then, on the flip side of that, is it quantifiable? He also wants to cut regulation. Would this be a growth? Would this be a big growth encouraging measure? Harris also has some growth encouraging measures. She wants to give tax credits to small businesses. Her record, she's obviously being big on big state intervention. She will be supportive of the measures that under the Inflation Reduction Act, which some would say is a misnomer, but basically if it does achieve economies of scale on energy transition, then then the jury is out. It could still be successful. It hasn't been as successful as say the CHIPS Act, which definitely has had a quicker impact on growth in America. But the thing is neither of them are talking about cutting entitlements, which is why the spending is still projected to balloon. I mean, if Trump's cutting taxes, he's not going to go after Medicare or any of the a lot of the entitlements there, because that's his. The base now is very much blue collar workers, so they're still in a stage, both sides of promising everything to everybody. And so the fiscal,
the classic pre-election, and quite often post-election stage as well.
Yeah, fiscal discipline is so I think bond markets will be will probably I don't expect real rates to come down as much as people may hope, and things like the gold price may continue to be elevated, but then some of the either may provide good stimulus for equities. So
indeed, well, all will be revealed soon on that front, but there's no doubt these issues are going to persist for years longer either way. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to turn to our next segment now, looking at the price of cocoa, the price of chocolate, which sadly, for those of us with a sweet tooth, has been soaring in recent years. There's been a bit of a dip over the summer, but it's still far higher than it was a year ago. Madelaine Apthorpe is here to discuss more.
So cocoa prices have been insanely high at the moment. I think at the moment it's around $7,000 a ton, but in April it was about 9,500. And compare that to April 2023, it was only 2,800. So a massive, massive jump, really. And it can be pinned down to a few things. Climate change and El Nino is kind of the primary factor, which is, if anyone doesn't know, it's responsible for the speed and strength and temperature of wind in the Pacific Ocean. So that then blows across and, in this case, affects the cocoa belt. So that's kind of West Africa. I think Colombia is also in there and some places in Indonesia as well, but the piece mostly focuses on West Africa. There's also another season that's affecting it, which is called Harmattan. I think I'm pronouncing that right. It's just dusty winds blown from the Sahara, really quite strong winds as well, so they can knock cocoa pods completely off the trees before they're even fully developed. So that's causing some losses as well.
And there's also secondary impacts from climate change or from disease, certainly, in the nature of, because it takes a long time for cocoa to be produced or to be able to start producing new cocoa trees, because they are trees and you need to plant them.
Exactly, yeah. I think it takes like 4 to 5 years for a cocoa tree to actually start producing pods that you can use. And I think it's something like each pod has 35 beans in it. And for one bar of chocolate that you get in a corner shop, that has 30 beans of cocoa in it. So it's, you need a lot of cocoa to produce it, and obviously the backlog is not great right now because of climate change.
Disease, there's various diseases.
Yes, so there's 2 diseases at the moment. One called black pod disease, which is a fungus that travels via rain splash, and then there's also swollen shoot virus, which is transferred from tree to tree by a little bug called a mealybug, which is quite a sweet name, but they're massive pests. And both of these diseases can result in losses as high as 30 to 40%.
So clearly this is going to persist for a while, we think, based on the price increases and the factors behind it. Let's talk about the big companies involved. That'll be Hershey and Mondelez. They're clearly going to have hedged their price exposures for a good few months or years, but eventually those hedges will roll off. And there is some suggestion from analysts that they might not be as insulated as you may have hoped, Hershey in particular.
Yeah, I think they said that they're going to be passing on a lot of it to consumers, but not all of it. So they'll probably take a bit of a hit to their margins.
I think Jefferies downgraded them this summer on that basis, didn't they? To a sell, saying that
right.
saying that they wouldn't be able to pass on this increase, which is something we've seen with consumer staples over the past couple of years. Clearly, there's been a lot of price increases for a lot of goods, and people have been able to pass them on fairly effectively from the company's point of view, if not consumers' point of view. But now we're at a stage where it's a bit trickier. And clearly, in this case, people think Hershey doesn't have that much pricing power to do that. But there are some interesting phenomena when it comes to chocolate consumption and our propensity to keep consuming it. Something called the lipstick effect has a significance here.
Yeah, so the lipstick effect is kind of a phenomenon where in kind of harder economic times, when people have less money to spend on things like, a new car, a holiday, bigger things, they tend to splash out on smaller little things. So, that's like coffees, margarita in cans, or yeah, as the name suggests, lipstick.
Yeah.
So that's kind of currently happening and is probably driving a lot of people buying like Tony's chocolate and like Lindt chocolate instead of maybe just getting like a cheaper Cadbury's or something like that. They want to treat themselves slightly with their Friday night binge of
At
chocolate.
home. Yeah, that makes sense. Well, I can't say I'm a complete stranger to that phenomenon. In the teeth of that, we have seen some price increases come through even early this year in Easter for various chocolate goods. And also the inevitable, it seems to be, snacks always suffer from this, most of the shrinkflation as well.
Yeah, shrinkflation definitely. I think it was like a large Mars milk chocolate egg was down like nearly 50 grams from 2023 to 2024. I'm pretty sure. And then it's also the prices as well. Like chocolate bunnies, the Lindt chocolate bunnies, cost 55% more in some retailers this year than they did last year. Same with mini eggs. They were about 50% more. And I guess because it happens annually, and you buy. You don't really remember how much you're paying for your Easter egg a year ago, so maybe people will forget, but it's quite dramatic increase.
Yeah, those kind of one-off purchases, you're right, are much harder to remember than if you're buying a twirl every week or something like that. Let's wrap up by talking about some of the smaller producers. And we spoke in the piece to a few companies. Nestle got some comments in there too, and Lindt in there as well. But there are, of course, smaller producers in the market, much like something like coffee, say, where you get these artisan chocolate producers who are probably at this point it's difficult for them as well. I would imagine, and certainly the implication of the piece seems to suggest as much.
Yeah, I mean, I spoke to the CEO of something called Islands Chocolate. They produce chocolate mostly in the Dominican Republic, or cocoa in the Dominican Republic, and he said that instead of like not just cocoa itself, but like sugar's also increasing and cocoa butter. He was saying about a year ago they were buying it for £6-7 a kilo, and this summer they were buying it for £40 a kilo. So it's a massive jump. And he was basically saying that they're decently positioned. I think they'll be okay. But a lot of the smaller companies or people who want to break into that industry simply won't really be able to. So it's shutting down the space for artisan producers to really enter the market. And from that kind of just creates a space where these bigger, more insulated kind of companies will just be able to kind of take that market share. So Mondelez, Hershey's, they may just kind of keep getting bigger.
They although they face these pressures, there's the opportunity for them to elbow their way in and have a different brand which markets itself as being more sustainable, more
more luxury.
True. Well, that too, exactly. I mean, we have seen this with various goods. It seems that, I don't know, it's a burgeoning theory I'm personally forming, where the spread of prices between the high end and the low end isn't actually that wide anymore, partly because all things that were cheap have got much more expensive, and things that were already expensive only become a little bit more expensive, which I have no idea what that means for consumer buying preferences in future, but there we are. It seems cocoa is going the same way. Okay, well, we've got to hurry on because we're going to turn to our final segment before we run out of time, and that's on Boeing. The US plane maker clearly has been in the news a lot in the past year or beyond regarding safety issues, regarding supply chain problems, and now there is the prospect of a machinist strike, which so far has not resolved in any way, as tends to be the case in the early soundings of these disputes. Julian, why don't we start with you? Why don't we outline, I suppose, the demands that the workers want and what Boeing has said so far and what the knock-on effects might be? We can get onto those as well.
There are a few sharp objects on the runway for Boeing at the moment. So basically, it's got two issues. So this strike that we've mentioned with its machinists is particularly damaging because it reduces the company's production. So it needs to produce something like 40 planes a month in order to keep on top of its cash flow needs. And at the moment, it's down to 33 because people are downing tools. The machinists are still largely in negotiations, but Boeing has just withdrawn a 30% pay increase offer. So it looks like it's going to dig in for a longer fight. Depends on how long that is. The other problem they've got is that yesterday, or at least as we were talking yesterday, the ratings agencies are going to imminently cut its bonds to junk, which is quite a come down really for a company that was the kind of marquee name in American corporate blue chips for many, many decades in the 20th century and into this one. So that's difficult for a firm that's carrying about 40 billion in debt since 2018. So it's amassed that amount of debt in the aftermath of the accidents which plagued the Boeing 737 Max. And so its problems are piling up. But there is a school of thought that says that these might not be as terminal as would be the case for any other company. As investors are well aware, Boeing is part of a duopoly. The other serious contender, of course, is Airbus, and between them, they dominate 95% of the wide-body jet market. And basically, it's got so many unfulfilled orders, which is sort of more, 6,200 planes, which means it has a 10-year backlog of guaranteed work because basically nobody else, there's no other plane maker that its customers can turn to. So on the basis that represents billions and billions of free cash flow, it's unlikely that this particular strike will derail Boeing particularly. But the problem that other companies face is that it's rippling out into other parts of the supply chain. And we saw recently that Senior, which is a well-known engineering firm here in the UK, its shares dropped by 14% a few days ago on the back of the news of this potential strike. And it is such a vast consumer. Boeing is such a vast consumer of spares and parts that it's almost inevitable that other companies will get caught up in this kind of slipstream.
Yeah, that does seem to be the initial significant impact is elsewhere in this case, where others, as you say, are at this point unable to avoid the issues. It's kind of the final nail in the coffin in a way. I think Senior said they were looking at furloughs and job cuts given the strike and also the supply chain issues facing Boeing, but also facing Airbus, which speaks to what you were saying about it's not that Airbus will be able to immediately seize market share. We discussed this a few months ago, but they've got plenty of supply chain issues of their own.
Really, it's been an issue that they're saying is at least 2 years before it'll clear. But I mean, which makes sense really. I mean, given aircraft parts are heavily regulated, so it's not an industry that you can suddenly scale up to meet demand. It has to be rigorously assessed and tested before it gets anywhere near a plane.
Yeah, indeed. I suppose you've got to wonder about the bigger companies as well. I think Rolls-Royce it was who said it could be up to 2 years. So clearly they've been flagging this for a few months now. But you wonder if, as time ticks on about the implication for other big companies too. Clearly Rolls-Royce have got a few strings to their bow, but there's something to watch there as well, perhaps.
It is something to watch. I mean, the difference, I guess, is that a lot of the other companies do have sidelines which are also quite profitable. So the thing that has weirdly come back into fashion and something which nobody expected before 2022 and the invasion of Ukraine is that defense is now has massive potential for profitability because countries are now upgrading and upscaling their militaries. I mean, there's a report 2 days ago that NATO needs 250,000 more soldiers and will double the size of their air forces. So I mean, if you're a Rolls-Royce that has a lot of defense lines, Boeing's troubles are probably more easy to manage, whereas a smaller company down the line that has a large proportion of sales that are dependent on certain models, certain types of plane, and can't easily offset those against other sale lines are the ones that are currently suffering. So there is a distinction, I think. I know, but Rolls-Royce has had troubles of its own. It's also had to massively reshape its business to stay competitive, stay solvent, and it will probably feel the benefit of that kind of forced restructuring. But I mean, Boeing's problems, they've been going on for years. I mean, they've been told, you could file them mostly under the heading, we need to run the company better. So there's a whole list of things they've got to do to improve their operations, which they've agreed with the FAA. But I mean, they first agreed that in 2018, and we're here 6 years later, and they're still talking about the same problems.
Yeah, well, they've got a new CEO in place, as you might expect, given all the issues. So clearly, there's a lot on his plate. The pay offer, as you say, 30%. I think the demand was 40%, which obviously are huge figures. But then you see that the pay has apparently risen over the past 8 years, only 4%, which clearly is way below inflation. So I mean, that's a kind of a UK level of wage growth there, which perhaps leads us, though, on the subject of wage inflation, to bring you in, Mark. I know you've been patiently waiting, as you were at the end of last week when you had some flight issues of your own, I believe.
Yeah, it's an unfortunate incident in France, which was best left in the annals of history now.
Indeed. Well, you made it home in the end. But yeah, you've been looking at not just clearly this strike going on in the US, but some signs of stickier inflation, or wage inflation at least, in the UK.
Yeah, I think the fear is that this issue of Boeing, it could be symptomatic of a wider trend that's been brought about by the rapidity and duration of the inflationary surge, coupled with COVID after effects as well. Because economists now are getting worried about the potential for a secondary inflationary surge due to wage increases. We've seen other examples of this over in the US recently with the East Coast dock workers strike. Well, they haven't gone out fully yet, but that issue is still ongoing as well. I think the last labor dispute with Boeing lasted for a couple of months, but the problems there, they're not confined to Boeing either. Some of the companies involved in the supply chain, or another aviation company called Textron over in the States, that's had some labor market pressures as well, and problems linked to wage rates there. In the wider US economy as well, the minimum wage hasn't changed in years, but I think it's well over 10 years now. That may change after the election, of course. But the individual states, about half of the individual states have increased their minimum wage in response to those post-COVID pressures. Now, there's always going to be an effective lag, isn't there, between a fall in real wages and then the trade unions' reaction to it, and that's what we could be seeing at the moment. Closer to home, of course, we've seen some pretty steep wage increases in the public service sector following the election as well. There may be a political aspect to that too, but you look at in the UK, for instance, average weekly earnings in the July quarter fell by, or rather increased by 5.1% from the equivalent figure in 2013. And inflation now may well be dipping below 2%. So if that trend continues, it spells potential trouble for companies. I note that with Boeing as well, one of the chief problems they've had is trying to grow their free cash flow levels. And if this dispute worsens, or even if it stretches out much longer, that's going to become a real issue for their financial performance too. All of this may not leach through to the economy to the extent that it becomes, I was going to say, a structural issue, but it's not. It's an inevitable issue in a sense. But its severity rather depends on the labor market too, the balance of the labor market. What could actually be beneficial would be a few fewer applicants for every job, and there's evidence to suggest that may be happening at the moment, but it's certainly worth keeping an eye on.
Yeah, well, certainly I think central bankers are now more concerned about the number of applicants, i.e. the unemployment rate, which should have a restraining effect on a broad level, shouldn't it? But as you say, on a company by company basis, it's clearly a sign that they can't think, oh, we're out of the woods now in terms of workers wanting more money. In some cases, a catch-up kind of rate as well. So yeah, certainly something to keep an eye on in terms of individual companies and at a broader level too. That does bring us to the end of today's show. Thank you very much to Mark, to Julian, to Maddie, and to James, and to you for listening. We'll be back next week with another